So, have you ever just stared at your crypto portfolio and wondered, why is everything crashing at the same time? Or, on a good day, why is everything pumping together? It really feels like it doesn't matter if you picked a solid project or some random meme coin. When the tide goes out, all the boats sink. So let's pull back the curtain and see what's really pulling the strings.
I mean, it's one of the most maddening things in crypto, right? You do all your research, you find a project you really believe in, but its fate seems completely out of its hands, and yours. So what is this invisible force at play here? Is there a real reason everything moves in lockstep, almost like it's some big choreographed dance?
Now, you might be thinking it's just broad market sentiment, or maybe everyone is just hitting the panic button at once. But the real mechanism, well, it's something deeper, more structural, and honestly, it's largely invisible to the average investor. Okay, so the first piece of the puzzle is this concept called capital rotation. The best way to think about the crypto market is not as a collection of individual islands, but as a single interconnected ecosystem where money is constantly flowing from one place to another. Here's kind of how it works. Money flows from the traditional financial system into the major assets. We're talking primarily Bitcoin and Ethereum. From there, as investors get a little more confident, that capital rotates down the risk curve into altcoins. And, of course, when fear takes over, that flow completely reverses, from altcoins back into the perceived safety of Ethereum, Bitcoin, or stablecoins. This right here, this is the engine that drives the market cycles. But, capital rotation is just the big picture. To really solve this mystery, we need to zoom way in on the single most important mechanism linking your altcoin's price to the giants. It's called the Ethereum coupling effect. And trust me, this is where the story gets really interesting. This concept, it completely flips the script on what you think drives price. Most of us assume our altcoin is going up because people are buying it with dollars. But the reality is, most altcoins aren't primarily traded against the US dollar. Nope, they're traded against Ethereum in what are called liquidity pools. This means if big players are buying up a ton of Ethereum and its price rises 10%, your altcoin, which is priced in ETH, automatically rises 10% in dollar value too. Think about what that really means. Your altcoin's price can shoot up without a single person actually buying it. It's just getting pulled along for the ride by Ethereum. So the next logical question has to be, who is moving the price of Ethereum? And the answer, increasingly, is Wall Street. Institutional players and treasury companies have been accumulating Ethereum, and their actions have a truly outsized impact on the entire market. Just look at this number, $250 billion. That's how much value was added to Ethereum's market cap since institutional buying recently ramped up. It's an absolutely staggering figure. But here's the real question. How much money did it actually take to generate that much value? Okay, this is the kicker. That $250 billion jump in value, it was generated by only about $16 billion in actual purchases. That is a nearly 15x leverage effect. So the crucial point is, this isn't just about the money flowing in. What we're seeing here is a classic narrative-driven rally. The story of Wall Street buying in is creating far more hype and demand than the actual money itself. The market is running on fumes, reacting to the headline more than the reality, which pulls the entire altcoin market up with it. But there's one more hidden force at play, and this one is working against you. This might be the single most important factor that most retail investors miss: the constant, crushing pressure of token inflation. See, many altcoin projects have tokenomics that schedule massive releases of new tokens over time. These tokens are often given to early investors, venture capitalists, and the project team itself, who then, what do? They sell them on the open market. This creates a constant headwind, always pushing the price down. And this is not just a theoretical problem. Take a look at some real projects. The supply of DYDX is inflated by 70 times, Fetch.ai over 22 times. For the price of these tokens to just stay flat, demand has to constantly absorb this massive wave of new supply. To go up, it's an incredibly difficult battle. So what does this all mean? It means the game is often structured for insiders to cash out on retail investors. They get the tokens for cheap or even for free, and the market becomes their exit liquidity. This is the hidden trap that explains why so many altcoins bleed out over time. And the numbers, they show just how stacked the odds are against you. In the last year, among altcoins ranked 300 to 400, a staggering 92% of them did worse than just holding Bitcoin. The odds of picking one of the few winners are incredibly slim. It's the ultimate trap.
We only ever hear about the 8% that win, which is a textbook case of survivorship bias.
So, knowing all this, the capital rotation, the Ethereum coupling, and the inflation trap, how should we change our approach? Well, it requires a fundamental shift in the questions we ask. First, you have to stop obsessing over the US dollar price. As we've seen, it can be a really deceptive metric. A lot of the time, it's just reflecting what Ethereum is doing, not the health of your specific project. Instead, start asking how your altcoin is performing against the market leaders. Is it gaining ground on Ethereum? Or is it losing value even while its dollar price is going up? That ratio chart, that tells a much truer story of its strength or weakness. And just as importantly, you have to investigate the tokenomics. You've got to ask, is there a massive wave of new supply about to hit the market? Understanding the inflation schedule is just non-negotiable if you want to avoid being someone else's exit liquidity. Ultimately, it all comes down to this one question. When you buy an inflationary altcoin, you're not just betting on its technology or its team. You're fighting against powerful structural headwinds. And knowing that, well, that might just change everything about how you see this market.